Good morning. I'm here with Nino Tronchetti PROVERA, who is the founder and managing partner of Ambienta. Good morning, Nino.
Good morning, and thank you for inviting me.
Please introduce yourself and your firm.
Nino Tronchetti Provera, managing partner and founder of Ambienta. Ambienta is an asset manager entirely focused in applying environmental trends to the world of investing. Today we manage short of 5 billion euros in private equity, private credit, and public equity. Out of 4 offices in Europe, and we are focused on European environmental champions.
Very nice. You cover a couple of strategies. What do you think are the biggest trends at the moment, but also what are the biggest challenges for private equity, private credit, etc.?
But listen, after a booming market, explosive growth for over 30 years, for the first year, probably this year, the market is kind of flattish. No surprise, markets cannot continue, industries cannot continue to grow forever, but that comes with a few consequences. Combined with that, you have the last few vintages, which kind of were late stage in the cycle vintages. Private equity is very cyclical. No? You have booming fundraising, which is what we call late cycle, and that typically drives the worst performance, and vice versa. When there is less money, so early cycle and fundraising is down, those are the best cycles. Now, you have all the 2018, 2022 vintages that are supposed to be bad vintages because of the late cycle dynamic in fundraising that counterintuitively are marked as if they are about to become best vintages, and most of that value, which is marked at very nice returns, is of course unrealized. Now, that calls for a bubble. On top of that, M&A is at the lowest, and I think it will stay at the lowest for quite some time because the economy is slowing down. And the combination of that explains why you have a lot of secondaries, which is kind of creating artificial liquidity. And I think that sooner or later, those NAV will have to mark according to reality, which means that probably the largest part of those portfolios will have to be reduced in terms of returns. Nothing to be worried about. Darwin typically starts working in industries where they move from big growth to flat. In an industry where I've never seen an industry where there is such a difference between the top performer, the top quartile, and the rest of the pack. So I think that the winner will win even better, and the losers will suffer even more.
You are very focused on sustainability investments. How do you think sustainability, the concept of, has changed in private equity since you started?
Listen, you're touching a very sensible point for myself, also personally. I've been focused on these trends for 34 years. And the reason for that is that because of very basic numbers, the economy moving from 2 trillion to more than 100 trillion in less than 50 years, and therefore demand-supply imbalance on both resource and pollution, which calls for very basic economic reasons why environmental champions should outgrow the rest of the economy, and talking about resource efficiency and pollution control, in an industry, in a trend that should be driven by science, because you need science, you need engineers to understand what are the issues, what are the solutions, what's scalable, what's really better than the traditional business models. Addressing issues that unfortunately in the last 50 years have been reaching a point that wasn't expected even by the most pessimistic scientists 50 years ago. Finance instead has been progressively developing an array of concepts that are mostly artificial. We started with SDG. Nobody, if you know the SDGs, nobody can be against the SDGs, but they were not designed to drive an investment policy. They were designed to signal to the business community what's right and what's wrong. But you pretty much can do SDG-driven investment in pretty much every industry and with pretty much every strategy. Then he moved to ESG, which is not really pointing at what a company is doing, but is much more pointing at how a company is run. I am very happy. I was very happy. I received the very first Hall of Fame award for ESG. But as I've explained when I accepted the award, you can make the best ESG company and produce a chemical weapon, okay? Because it doesn't really differentiate because of what a company does. Then they moved to impact. Then they moved to purpose. And as I've said a few months ago on stage, even Al Capone had a purpose. So to make a long story short, finance has been developing concepts that have much more to do with philosophy than with science. And that created investment policies and portfolios which honestly have nothing to do with green issues and solutions. Nothing to do with science, nothing to do with environmental trends. Therefore, you neither have alpha, which means returns, nor you are authentic with respect to the investors that gave you money in good faith. They wanted to address those issues and they wanted to have returns out of those issues. Now, that bubble is kind of the reason why a lot of people now are skeptical. They're kind of pissed off, right? Because if I invest to address environmental issues and I find myself with portfolios, now I'm referring to public equity, where I have Coca-Cola, Walt Disney, BP and Total. Those are maybe fantastic companies, but they're clearly not green champions. That's kind of, yes, there is the US narrative, which probably triggered this trend of taking out money from that, especially in private wealth. I don't see that with major investors, but I think that investors are becoming more sophisticated in selecting the authentic players from the rest of the pack, which are mostly based on, if I may, fake concept and greenwashing.
What do you think the current market sentiment is? You said skeptical. Are people therefore investigating deeper before they make investment decisions, before they hand over money? Do they want to have better reporting? How do your LPs, act when they invest? What do they tell you they want from you so that they are happy and they don't feel that they've given money to a fake?
As a general trend, what I'm hearing, basically all across the board, in Asia, in North America, in Europe, which are where our investors coming from. Listen, for 30 years, the market was booming. So they kept amassing GP relationship and funds. To a point, I'm talking about the big allocators, okay? People investing 5, 10, 20 billion a year. They found themselves with more than 100 GP relationships, sometimes 150, and hundreds, 400, 500. And they understood two things. On one hand, that means 100, 150 AGMs to attend, 2,000 quarterly reports to review per year, which means you need a machine to do so. And second, they understood that because of the top quartile versus the rest of the pack concept, most of those GP relationships, most of these funds were not really bringing alpha and diversification to their portfolio. So to make a long story short, what I'm hearing very consistent across the board is that most of these LPs have decided to reduce the GP relationship to what I'm hearing is 25 core relationship and 25 tactical relationship, which means that you have 50 to 100 GPs. They used to have these guys are core investors, anchor investors that will not have them anymore. And of course, this is creating problems. In order to play, their attitude is, I will invest 70% of my money into the big guys that are able to absorb this big capital. And for the remainder 30% of the portfolio, I'm looking for two things. I'm looking for alpha. Alpha means 20% upwards net returns. And I'm looking for diversification. It can be thematic, it can be geographical, it can be a kind of strategy, turnarounds, whatever, but that's what you should be aiming to achieve as a GP in order to be in those 25 core, or at least in the 25 tactical relationship. And that's, I think, what we're doing. We know that the name of the game is 225 in terms of returns. We know the name of the game is authenticity for us, because that's our claim to fame related to environmental trends. And we try to be consistent with what we have been doing for 18 years.
Talking about the wider industry and private equity spurring on systemic economic change, what do you think is the biggest opportunity, or what are the biggest opportunities for PE as a sector or an industry to do that over the next 5 to 10 years?
Listen, I have a bias, right? Because I've been investing 34 years of my life for what I think is the biggest revolution in the history of the economy, environmental trends. Without considering that, which to me would be number one. But listen, I think that if you look at the economy out there, is clearly the digital revolution, AI. If 4 US players, companies are investing $2 billion a day into data centers, that can be considered a gigantic opportunity, I shall think. Then the return of investment of all those capex are to be seen. You may question them, but that's clearly, AI is clearly a big revolution, which I think is much deeper into the industrial than what most people have understood. It will change supply chains, logistics, operations, factories, among a lot of other things. If you are in Europe, I guess defense. Please don't mix it. I know that now this ESG darling wants to include defense, no? As if you are, and when I see defense and green, I have a hard time. Maybe a countryside kind of guy, but how you mix green and defense, it needs to be explained to a normal human being, but that doesn't mean that defense will not be good. So these are the obvious one. I think that one key argument is geographical diversification. If you want growth, you clearly don't have growth in Europe. You have growth elsewhere, and to make sure that your companies are able to play globally, or at least in some of the geographies, seeking growth, I think that calls for scale, that calls for sophistication, that calls for management teams of a certain quality, etc., etc., etc. But you know, I've been saying for all my life that life is 5% strategy and 95% implementation. So I guess that's what I'm focusing on.
Thank you, Nino Tronchetti, PROVERA, for these insights. Very, very big pleasure to have you.